Hey everybody, I just wanted to go through what's happening in the Squamish real estate market, the Canadian economic conditions, as well as the Canadian housing market. If you've watched the video already, we've got the probability direction index, which is at a 2, which is indicating that market price pressures are pointing that the probability are that prices are going to trend downward. We are seeing a little bit of an inflection point, so that could be a stalling of the downward movement, or it could mean that we could trend back upwards, hence why we're sitting at a 2 and not at a 1 or a 0, indicating that we're certain prices are going to continue to fall. So that's where we're seeing it at right now, and I just wanted to share that with you, and we'll get on to economic conditions in Canada and teaching you a few things that might be helpful for you to know down the road. So you may have heard people talking about yield spreads. And these are really critical when it looks at predicting what's going to happen in the future in the economy. It doesn't mean what's going to happen in the stock market or the housing market. It's just the real economy that they're looking at. So historically, people look at the 10-year minus the 2-year. And the way I'm going to explain this is, if somebody was going to loan you $1 million and you were going to pay it back tomorrow, they feel pretty confident that they're going to get that money back from you quickly, and they're going to get it back because not much can happen in a short period of time. So there's not much of an interest premium that you're going to pay on that. Now, if in turn you say, hey, I want to get that money for 10 years from somebody, then they're going to say, hey, we're going to charge you a higher interest on that money because anything can happen within that 10-year period. You could lose it all. We want to make sure we recoup some of our money that we've loaned out to you and make sure that it's safe and we're not losing any opportunity to invest that money because the time frame is so long. So normally when you subtract that 10-year rate outlook from the 2-year, you've got, say, a 5% 10-year and you've got a 2% 2-year. The difference is 3, which is a positive yield spread. Now, if for some reason somebody thinks that, hey, in the short term, there might be some huge risks ahead of us versus a lot further out, there's not much risk if we look down 10 years down the road. Then you get somebody who's willing to loan you 10 years down the road for 5%, but if you're going to pay it back in, say, 6 months or a year, they're going to charge you, say, 7 or 8% because there's a real risky period coming up in the short term. And how that plays out is it plays out to show that there's a potential recession looming. Looking back from like the 1980s all the way through to current, so we're 40 years of historical data. So you see that every time that the 10-year minus the 2-year dropped below 0, or got what they call inverted, and it was followed by a recession. Now that recession was anywhere from about 6 to 12 months out from the time that it crossed down below the 0 level, and lo and behold, right now we're sitting below 0. So that's interesting. We're also as low as we've ever been, and often the depth of the inversion is often an indicator of the depth of the recession to come. So keep that in mind when you're looking at that. Now, the other one that is more accurate, now when you go back 100 years, you'll find that this kind of falls off and it's not quite as accurate. And you'll even see actually the 10-year minus the 2-year, there was a sort of a pop here, but then it went through again, and then it popped here, and then it went through again. So there's a few sort of false signals or sort of signals that are way too early to have you learn what could happen. So they went back and they started looking at the 10-year 3-month treasury. And what you'll find is that, or what I've found anyways when I look at it, it's not that when it comes through that matters. It's when it comes back over the 1 that indicates we're going to be heading into a recession within 3 to 6 months. And it's been pretty consistent throughout history. And when you go back and you test history, now here's one where it didn't quite work out as well as we'd like. As far as the numbers go, it was actually about 8 months, but still it's a closer indicator than the 10-year minus the 2-year. And then when you go back historically about 100 years, it does end up being accurate every single time we've led into a recession. So this one again currently is down below, and now it has started coming back up. So we're seeing the trend start to come back up. The question will be, once it gets above 0, does that mean we're 3 to 6 months out from a recession? And it likely does. So I'm bringing that up because obviously a recession would have a major impact on housing prices. While housing prices have gone up during recessions, especially if they're short recessions, during longer recessions or deeper recessions, housing prices tend to fall because employment falls. People will sell their houses to get them on the market. They need cash infusion. Banks will foreclose on people because they can't afford to pay their mortgage, that sort of thing. So that's what causes the drawdown in housing prices. Now, currently with the economic situation, Tiff Macklem, who is the head of the Bank of Canada, versus Jerome Powell, Tiff has said that they're not going to be increasing interest rates. They're going to go on a pause. However, he did say that there's the potential that it could be a temporary pause and that they could resort to rate hikes again if they needed to. Well, the data's coming in and the job market looks fantastic. The economy looks good. Tiff is probably going to have to, after one pause, probably go back to rate hikes. In the States with Jerome Powell, he has actually said that they are not going to stop increasing the rates. And in fact, the FOMC, which is the governing body of the Fed, they've said that basically they support a 0.25 interest rate hike and are looking to even support a 0.5 should the Fed decide that's what they want to do. Now, that's going to have a major negative impact on housing prices. Even right now, we're looking at 10-year yields in the 5% range. And with that yield in the 5% range, there's a double impact. It's causing people not to be able to afford as much as they were before. It's also taking some investors out of the pool. Two problems with that is, one, an investor can get a high return just by investing in a treasury or a bond and get upwards of 5% return versus taking the risk on an asset that might be falling. So they're stepping back and not getting into the fray. Also, their mortgage will be much higher, and even though rents are increasing, they're not increasing at a rate that's fast enough to compensate them for buying a property and carrying a higher priced mortgage on the property. So those are sort of some interesting things that are happening in the Canadian economy. What I want to talk about with the Canadian housing market specifically is that the market conditions here are different than they've ever been. So there's a low inventory level across Canada. The one market in Canada that has not been behaving poorly is Calgary. It's a strong market. We're seeing prices go up there. There's good inventory and things are rocking out in Calgary. However, everywhere else across Canada, there's a low inventory level situation with the number of immigrants we're having come into the country, the amount of immigration that's coming in. That's not helping the inventory levels at all because they're actually usually higher qualified workers that are coming into Canada. That's Canada's play on trying to increase the education level of our country is by bringing immigrants in. In fact, I think they said 90% of the population growth in Canada is immigration. So 10% comes from births and 90% comes from immigration. So that's pretty crazy statistic, but that is what's happening. So when that happens, you're getting this influx of home buyers, which is causing push on prices. Now, that there leads another challenge is that most of these people that are immigrating into Canada, by the way, I'm an immigrant myself, came from England, so I have nothing against the immigration policy as far as bringing people in. I love the fact that Canada is a great melting pot and we have that opportunity. But the challenge is also these people that are brought in are not being brought in and able to get higher paying jobs. And in fact, I think it was 40% of people feel that they are actually entering into the workforce into a job that is close enough to their abilities. Most of them are underperforming in their job. So they're also being underpaid. And then with the higher prices of houses, they can't afford to buy houses. So it's a bit of a catch-22 that we're engaged in right now. So I just wanted to bring that up. With all the data that we talk about, and I am going to go through the Squamish data, one of the things that people are failing to recognize is that when you've got a group of home buyers that are a group of people that are buying homes, there's usually like a 5-year span, and those people are within the window of buying their first home. The people that are selling the big houses and downsizing, they're within a 5-year window. You get this group of people that are out there trying to buy homes. Now, COVID came, and all these buyers got pulled forward into the time of COVID. And so we've been left with fewer buyers. So you can see that there's a sort of play coming in here where we don't have the same amount of buyers as we've had in the past. We currently have low inventory levels. Prices have not come down, so the immigrants haven't been able to buy the homes that they would have been able to buy otherwise. And so now that low inventory levels with a low number of buyers is preventing the market from showing signs of any shift in momentum. The current trajectory is down because interest rates are driving it down. But with the low inventory levels, we're not likely to see if this is a longer term drawdown or if this is a short-lived one. Now, I'm of the belief that we're entering into this sort of shift into what the purchasing motivation is for homes. 20 years ago when I started in real estate, everybody used to buy a home to live in. It was a house, it was a shelter, it was what they needed. And so people would buy what they could afford. It was a nice home, something to grow up in. Whether it was an apartment or a townhouse or a home, it didn't matter. They were buying it to be a home. Throughout the years, that has shifted, and people are buying homes for investment. So they'll look to see which area is going to go up the most. Do houses go up more than townhouses? Do townhouses go up more than apartments? Does this area increase more in value than this area? And that's been weighing more and more on people as they're buying homes. They're seeing houses as an asset or an investment as opposed to what it should primarily be, which is a home. So I just want people to think about that is probably going to shift. Because people can only afford a certain amount, they're going to change their attitude and start looking for things that'll be a home for the purpose of a home and no longer for the purpose of an investment. That'll change the dynamics of how the market behaves, and I really think that's going to have a big impact moving forward. So I'll go through the Squamish data, but I'll also address the fact that people will say, oh, Simon, you're thinking the market's going to crash. I'm definitely not saying the market is going to crash. I do believe we're having a lot of downward pressure, and the probability is that housing prices will continue down. Now, that works for a buyer because a buyer can be a little bit more patient in what they're looking for, but at the same token, when you find that property that you want to buy, you go ahead and you buy it because you're getting something that you want. Now, further discussion is it's very individual to each buyer. If a buyer has a large down payment and is taking a small mortgage, that'll impact the decision of how quickly to buy versus a buyer who has a low down payment and a large mortgage. A very, very different scenario for each buyer. So when we get into it, we can talk to your buyers about it. We can find out what's going to work for them, but it does impact them. Now, on the seller side, people say, well, if the market's going down, why would I sell? Well, if you are moving out of the community, you've got to look to see what's outside of the community you're moving to. For example, if you were selling right now in Squamish and looking to buy in Calgary, you would want to lower your price and get to a point where you could move the property so that you could buy in Calgary before the prices go up in Calgary and down in Squamish. Now, if you're moving within Squamish, it just doesn't matter. You're going to be buying, a property value of yours is going to come down. The property value of what you're buying is also coming down. It just doesn't make a big difference. So you have to look at where you're buying as to determine whether or not it's a great time to buy or sell. If it's an asset or it's been an investment, your tax implications are going to change dramatically as well. So if it's your second property, you've been renting it out for several years, you've been declaring the income, there is going to be capital gains tax to pay on that. Now, depending on how much money you earned this year or last year, or you think you're going to earn the following year, that'll impact how much profit you're going to receive on that moving forward. So you want to take that all into consideration when you're looking at buying and selling. So let's quickly go over the Squamish market data. And as you can see, quickly looking at it here, we're just going to do all property types. We're not going to go through detached and attached. But you can see how much the properties prices have fallen. So 1.2 million has come all the way down to 993. That's around a 17% decrease. Sales price is going to show a similar sort of drop, but it's not a rolling average, so it doesn't show as well. Percentage of sale price. Now, this is a really interesting one because we did get to a point there in early 2022 where housing prices reached 101%. So there's multiple offers going in, and then that's now fallen off, and we're down to 93.9% of the asking price. It's a fairly strong reduction in the percentage of original asking price. So whether that comes in the form of a price reduction followed by an offer that's slightly lower, or whether it's a very well negotiated lower price, that is a big impact on the market. that usually signals some sort of bottoming formation, and that's where we think there might be some sort of leveling off in the market. But the way the pressure is right now, and with interest rates, and if the Bank of Canada does shift their sentiment and actually increase rates, it'll have quite a dramatic impact, because nobody's really expecting that to happen. Days on the market. So here we go. I'm going to extend this out to 5 years so you can see. Back in 2019, we had lots of days in the market too, but then it fell off quite heavily here, and everything was selling as quickly as it went on the market. Now we're back up to 67 days in the market. So things are going to be on the market a little bit longer. Once we get the new properties coming on towards the end of February and March, you'll see that number fall. But I'm going to speculate right now that we're not going to see that number fall below 30. I think the average days on the market during the spring and early summer are going to be 30 to 45, which is quite high for that time of year. But that's where I think we're going to end up. Total inventory, you can see the inventory level is quite low. It says 121 right there. Currently, as of today, we're at 138 units on the market. And that's still extremely low. Well, you can see 138 below 150. Over the last 5 years, we haven't really been down below that very frequently. Now, when we were down below it here, prices were increasing because there was a glut of buyers trying to buy the limited properties that were available. But now we're at a point where we have a limited inventory on the market, and we also have a limited buyers falling prices. So a little bit of a different scenario than we had here through 2021, 2020. But that's kind of what we're looking at. New listings hitting the market. So we had a little bit of an uptick in the new listings. Again, that's a seasonal thing more than anything else. We're not sure exactly where we're going to hit until we get to sort of the middle of March. So we'll keep an eye on that. Number of sales. This one's also pretty dramatic. Only 17 sales in January. So it's down below, or down towards the lows of other winter markets that we've had. We expect that might even stay low throughout February and March. So we'll see how that plays out. Sales to active ratio. I'm going to extend this one out to 10 years just so you can see that this level of sales to active ratio below 0.2 doesn't happen very often. In fact, the majority of time in our market, we've been quite well above 0.2. The times that we have not, we've had a flat or falling market. So just keep that in mind with how things are looking. And even it's rolling over a little bit here. I don't know that it'll continue to roll that way. I think we should see it tick back up, but who knows where we go from here. So that's a brief look at sort of what's happening. I hope that all makes sense to everybody. I know that's a bit of a long-winded explanation, but I did want everybody to understand where we're coming from and why we're having the thoughts that we're having about the market. Something really important to watch, as I mentioned, are interest rates. So now you understand about yield spreads, and that really does change yield spreads versus just your interest rate when you're looking at housing prices. Hopefully that helps for you guys. If anybody has any questions about any of this, I'm more than happy to answer any questions at any time. Or if you have a topic about the housing market you'd like me to discuss in a video, I'm more than happy to do that. Moving forward, we are going to do a lot more videos. We are going to be posting them on YouTube. We'll have our YouTube channel up and running. It's going to be easy to navigate through, and as a result, you'll be able to go there to get all the information you need to know about the economy and the housing market at any point in time, so that you're well educated and prepared to make a decision when that time comes. Thanks very much. Have a fantastic day.